All right, fiscal policy, the discretionary changing of taxes or government spending to achieve economic goals, right? And there's three key pieces there. Excuse me. The first key piece is that it is discretionary, meaning they have to decide first off whether to do something, and if they decide to do something, they have to decide what it is, okay? So it's up to their discretion. It's to determine what to do, if anything. And the second piece is that it has to do with changing government spending and or taxes, okay? If it's not government spending and it's not taxes, then it's almost certainly monetary policy, not fiscal. Right? All right. Changes in government spending and taxation. Okay. Nice red one today. We are back here in this classical recessionary gap. And remember, government spending has to do with either, fiscal policy has to do with either taxing consumers or government spending money, okay? If we want to move out, engage in expansionary fiscal policy, government can increase its spending or cut our taxes, okay? The problem with this, of course, is that it results in crowding out. Government gets its money from us. So if they increase their spending, in order to do so, they either have to raise our taxes to pay for it, which is a wash, it just moves money from our pocket to theirs, or if they don't want that to happen, they've got to go out and borrow what they need. And we already found out that how they borrow it is in the bond market. Okay? They issue debt. The trouble is, when government goes and borrows money to pay for deficit spending, that's like an increase in the demand for money, and the price of money, interest rates will rise. Okay? Now we're going to get crowded out. As interest rates rise, all right, remember, government's trying to push it out, but as interest rates rise, consumer borrowing and spending falls. That's an offset. Okay? In addition, as interest rates rise, we know that business investment falls. Another offset. And there's an open effect, there's an open economy effect here. As interest rates rise, people want to buy investments in the United States. To do so, they need dollars. Demand for dollars rises, and the price of the dollar will go up. We'll go from $1 equals one foreign currency to $1 now equals two foreign currencies. Our goods now become more expensive. Okay? Interest rates rise, cause people to invest in the United States. To do so, they buy dollars. The price of the dollar goes up. Our goods become more expensive. And now, exports fall. So we get these offsets to fiscal policy caused by interest rates going up. Okay? Government's trying to increase aggregate demand, but to do so, they've got to spend more money. But to do so, they've got to borrow it. And when that happens, interest rates rise, which reduces spending by the other three components. Okay? Remember, if we are out here, then they want to contract the economy. Just the opposite happens. Okay? I wouldn't think it would work quite the same way, though. Okay? So what do? They cut their spending. That won't work in the same way, will it? Would they reduce their borrowing? Cause interest rates to fall? I wonder. I didn't even think about that. You know? We tend to just think about it in the opposite, in terms of expanding the economy. Right? Assume the increase in taxes. Sure. They could increase our taxes, right? Huh. I haven't even thought about that. I need to think about that. Okay. Yeah, you don't get the crowding out effects when they're engaging in contractionary policy, right? That doesn't happen. Does it happen in reverse? Doesn't make sense. Okay, all right. Okay, so when they go out and borrow money causes interest rates rise, we get crowded out. Okay, indirect crowding out caused by increases in interest rates. Reduce consumer borrowing, spending, business invests less. Okay, and I told you I don't believe this Ricardian equivalence theorem. That's nonsense. We don't save our money because we think we're going to get higher taxes in the future. Of course we're going to get higher taxes in the future. Don't we always? Tax rates ever come down? Okay. And then we get direct expenditure offsets. Okay, direct expenditure offsets. If the government increases its spending in an area that we normally spend money, it just reduces our spending. If they pay for more education, we pay for less. If they pay for more transportation, we pay for less. Okay? So to be effective, fiscal policy money has to be spent in areas that do not compete with consumer spending. Okay? Military, space, road construction, things like that. Okay? There's also a supply side effect, right? Meaning, if we're back here and we want to shift out to there to bring us back to full employment, all of the emphasis has been on aggregate demand. But we could also, or the government could also, decide, rather than shift AD out, cause an increase in aggregate supply, that also brings us back to full employment, right? And the argument against this was that if they, and how did they do this? They cut taxes on manufacturers, okay? If they cut taxes on manufacturers at every possible price level, more profit, more will be supplied at every possible price level, and we'll go from there to there, okay? And the criticism, again, has been that if government cuts taxes on manufacturers, they'll have less money to spend, and yes, SRAS will shift out, but AD will now shift in, leave us in the same position, okay? Because government has less money to spend now if they cut taxes on business. But the argument is that the stimulating effect of this tax cut on economic activity will result in more tax revenues. That if they cut taxes on business, more business will be profitable and making some tax payments, and if more people are now employed, they will be paying income taxes so that tax revenues should not fall. Okay, that's the idea. And there's some point where there's diminishing returns, right? Where there's a maximum, this Laffer curve, you're not going to need anything know about that. But at some point, it doesn't make sense to cut any more taxes. Okay, so that's supply side. Okay, supply side economics. The next major issue that fiscal policy faces, the time lags, right? We have 3 time lags. No matter what we're talking about, there's a recognition time lag. It takes us a while, a recognition time lag, okay? That's true for both monetary and fiscal policy. It takes us a while to figure out we have a problem. Remember, the official definition of a recession is 6 straight months of flat or declining economic activity. So it takes 6 months period to say, yeah, we are in a recession. But it really takes 3 or 4 months longer than that to figure it out. Although they have a pretty good idea when lots of people are showing up at the unemployment lines, right? That we're in a recession. Then, because fiscal policy is discretionary, we have an action time lag. Okay? They have to decide whether they should do something and what if they decide to do something. And there are so many people involved, and it's all political, right? Everybody wants to get a piece of pie for their area. All right? If I don't come home with some money, I won't get reelected next time. Okay? So we have an action time lag where they have to figure out what to do and come to some type of agreement. And it's both Senate and House of Representatives. And again, this is where we get the biggest break in monetary policy, right? The action time lag is much shorter because there's only 12 people, really one person, that makes monetary policy, whereas 500 and something make fiscal. And then we have the action time lag. Oops, sorry. The effect, sorry. The effect. Once they have decided to spend some money or cut some taxes, it takes a while for those policy actions to be felt in the economy, right? It takes a while to spend billions of dollars, okay? Problem with fiscal policy time lags, and less, but still true somewhat for monetary policy, okay, is that we're back here in a recession, and maybe, who knows, exports increase, AD shifts out to here now, and now the government begins to spend money, and AD shifts out again, and we end up with this inflationary problem, okay? So instead of fixing a problem with unemployment, that problem already got fixed by the time the money's being spent. It causes the opposite problem, inflation, and vice versa, okay? So the various time lags associated with fiscal policy might mean instead of stabilizing the economy, it destabilizes it. Rather than calm down inflation, it causes unemployment. Rather than eliminate unemployment, it causes inflation, okay? What else do we need to know about fiscal policy? Anything else? Oh yeah, automatic stabilizers. During normal economic times, right, when we are close to full employment, real GDP, we're in this general area, okay? Automatic stabilizers are very effective at keeping us stable, okay? Stable. If AD should shift in, it doesn't shift in by as much as it would. When you lose your job, you don't lose all your spending. Government now sends you money, unemployment compensation, right? So if I lose my job, my spending doesn't fall to zero, I start getting checks from the Social, no, who do I get it from? Department of Labor? Who is it? Yeah, but who are they part of? Treasury Department? I don't know. That's where your checks come from, though. Treasury, right? At any rate. Okay? Yeah, the unemployment office sends you money, right? Yeah, is it? It's been a while. Unfortunately, since I've collected unemployment. Yeah, jeepers, 30 years. Ugh, I don't even think about it. It's terrible, right? It's terrible to be homeless. It is. Okay? All right. So we have two automatic, right? We only have two automatic stabilizers. Unemployment compensation, you lose your job, your spending doesn't go down by as much, AD doesn't shift in by as much because you haven't lost all of your ability to spend money, okay? The government now gives you money to spend. Likewise, when you get your job back, AD doesn't shift way out. Why? Because now government stops sending you money, right? Now your income when you get your job doesn't go up by that monthly take home, it only goes up by part of it because you lose that monthly or weekly, bi-weekly, every 2 weeks they send you a check, unemployment, okay? And then our progressive income tax system, that mitigates, reduces swings in aggregate demand by changing the percentage of income that they take in taxes. As we get richer and we're buying more stuff and AD is shifting out, okay, moving in that direction, it doesn't move out quite as much. Because as we get richer, we don't get richer at the same rate. Meaning, as our pie gets bigger, the government increases the bite that they take, okay? So that as our incomes rise, AD doesn't shift out by as much because government takes a bigger portion of our income. Likewise, as our incomes fall, AD doesn't shift in by as much because government takes a lesser portion of our income in form of taxes, okay? So I know the book describes it in some other kind of way, but That makes sense to me. All right? So there's only 2 automatic stabilizers, and to be an automatic stabilizer, it has to work automatically. Nobody has to make any decisions, okay? It just works. All right? What do we really know about fiscal policy? Well, I hopefully know a lot. Right? During normal times, automatic stabilizers tend to be effective in keeping us at equilibrium, and that fiscal policy is not particularly effective. We're stuck with it. Why? Because government's going to spend money, and they're going to tax us. Right? So no matter what, we have fiscal policy. But during abnormal times, meaning when we are way back here, the Great Depression, okay, then fiscal policy can be effective because we don't get the crowding out effects. We don't get the offsets. Business, when we've got huge amounts of unemployment, right? 25% unemployment. Is business going to invest in new plants and equipment? Hell no. Nobody's buying anything. Okay? Are we going out and buying new cars? No. Nobody's buying anything anyway. We're all worried about the future. So that increase in interest rates really isn't going to have much effect on business investment or consumer spending. We're not spending or investing anyway. Okay? So it can be effective. In fact, Keynes, as you know, believed that there was definitely a role for government in the form of fiscal policy. And for that reason, we don't get nervous when the economy goes into a recession. We're not afraid that we're going to go into another Great Depression. Why? Because we know the government will take action. They'll cut our taxes and they'll spend more money to move us out of the depression. Okay? So we feel calm, soothed. The soothing effect of Keynesian fiscal policy. Right? Don't panic. Government will help. Government is here to help you. Right? Let's see, we had a few problems in fiscal policy. Did we talk about them yet? No. Suppose that Congress enacts a significant tax cut with the expectation this action will stimulate aggregate demand and push up real GDP in the short run. However, neither real GDP nor the price level changes significantly, meaning, what does that mean? AD doesn't move. So government cuts taxes, but nothing happens to AD. What might account for this outcome? What might cause that? Maybe, yeah. Well, actually, what they're trying to get you to say, the Ricardian equivalence theorem. Right? That if we get a tax cut, we're going to save the money, not spend it, because government knows we know that government's going to ask for it back later. Okay? Yeah, exactly. So I don't think that's going to happen. Okay? What else might it be? I can't think of anything else. Should just lift that out.
Well, people would use that money to pay off debts.
Pay off debts. That's true too. Did he talk about that in here? Does that chapter doesn't really talk about that, does it? Might. Yeah, I think it does mention it. That's right. Yeah, that's another thing. That, in fact, that's what the expectation was when Bush sent everybody that money back, right? That we go out and buy some more stuff, stimulate the economy. But we didn't. We just paid for the things that we had already bought. On average, I don't know if it's still true, but on average, we were engaging in serious dissaving in the economy in general. People were just consuming, right? Buying everything. In fact, they came up with a new term. Conspicuous consumption, meaning you buy things that everybody can see you bought. I parked that new Beamer in my front yard. Okay. I store my yacht right in the driveway. I want you to see that big screen TV that's coming into my house. Right? What? Why? Ego. Right? People want to be envied. Okay. All right, let's see. Determine whether each of the following is an example of an automatic fiscal stabilizer or not. 13-8, right? A federal agency must extend loans to businesses whenever economic downturns begin. Is that an automatic stabilizer? No, it doesn't happen automatically. Okay? As the economy heats up, the resulting increase in equilibrium real GDP per year immediately results in higher income tax payments, which dampen consumption spending somewhat. Yes, that is, absolutely. As the economy starts to recover from a severe recession and more people go back to work, government-funded unemployment compensation payments begin to decline. Yes. Okay. To stem an overheated economy, the president, using special powers, authorizes emergency impoundment of funds. No. Good. Consider number 13-10. Consider the diagram in the next column in which the current short-run equilibrium is at point A. That's an expansionary gap, right? Okay. Oh, yeah, that's right. Inflationary gap. The same thing, okay? In fact, on the final exam, you could see either inflationary or expansionary gap, all right? I don't know why. They used to call it expansionary. Now they call it inflationary. Yeah, I'm sorry. You know, I've taught this course 15 years now, and for the first 12, it was expansionary. Right? It's a hard habit to break now. Okay, but yes, expansionary. Remember, we're going to have expansionary equal to inflationary and okay, so you might see either one of those terms. Expansionary, same as inflationary, and contractionary, same as recessionary. Okay. So what type of gap exists? That would be, of course, the inflationary gap. If the MPC equals 0.75, what change in government spending financed by borrowing from the private sector could eliminate the gap identified in Part A? So they're basically asking you how much money does government need to borrow to move us from 15.8 to 15, right? Say what? Okay, well, let's see. If MPC is 0.75, what's MPS? 0.25. What's the multiplier? 4. Okay. So if we want to get down by 800,000, then they have to cut their spending by 200,000. Correct? All right with that? Okay. Is that it? Is there more? One more? Everybody writing this down? Turn it in? What? 200,000 less. They would have to cut spending by 200,000. Exactly. Okay? What change in government spending financed by borrowing from the private sector could eliminate the gap? Well, they wouldn't be borrowing money, would they? Yeah, they would just have to cut it. Yeah, exactly right. Okay, goodly. All right, you guys, anything else on that? That's it for 13? All right. Do we need to talk about 15? Yeah, I suppose. A little bit. Okay. I can hear that pizza at North Station calling me. Huh? With that cold beer, absolutely. But last Wednesday I went, right, after class. I don't do it on Monday. I don't have a cold beer on Monday because I still have more work to do, right? But on Wednesday I don't have any more work to do, so I have a cold beer with my lunch. But Wednesday they were closed. I couldn't believe it. I was like, I was looking forward to that so much. But the bar was closed at North Station. I don't know why. July 3rd. Why? Ah, well, probably nobody showed. They do, but they usually open at 12:30 in the afternoon, though, at lunchtime. So, yeah, well, just as well. I don't need another beer. Okay. So what do we have? Let's see. Reserves, right? That's what the bank is holding on to, and they come in two flavors: required and excess, right? So if the reserve requirement is 10% and the bank has more than 10%, they have excess reserves. Anything more than 10% of the total deposits would be excess reserves. And generally speaking, banks prefer not to have excess reserves. It's just cash sitting there not doing anything, okay? Functions of money, all right. It's a medium of exchange, right? Anything else has to be turned into money, okay? So money is the most liquid of assets, the easiest and cheapest to turn into other goods and services. Anything else is less liquid, okay? Remember what money is. There are three, we have our measurement of money, M1 and M2, okay? Currency, demand deposits or transaction deposits, money in the bank, your checking account, and traveler's checks, which are almost extinct. Okay? I'll spell it the English way. Okay. And then what do we have in M2? M1, exactly right. M2 includes M1, all of these, plus savings deposits, and what they call small denomination time deposits, meaning certificates of deposit of less than 100,000, and money market mutual funds. Okay, slightly less liquid. Right? There's no restriction. In fact, I don't know about you guys, but I can. When I write checks, I don't have to pay. I have to buy the checks themselves if I want anything nice. Right? Mine. What do you think are on mine? Turtles and okay. All right. So these things, no transaction costs, right? These somewhat. You can write as many checks as you want. You can use cash anytime you want, but your savings accounts, you can't just write checks on it. You've got to. There's not much difference really. Okay. And time deposits, CDs. You can cash these out, but typically there are penalties involved, right? If you turn in your CD early than before it matures, expires, then not only do you lose your interest that you were earning, but you have to pay a penalty on it. The bank really gives it to you, okay? So a medium of exchange, and again, barter. If we didn't use money, we'd have to barter, right? Exchange goods for goods. That happens today quite a bit. There's a lot of bartering going on out there, right? Okay? Honey, if you do the dishes tonight. Money is used to compare value, right? We use money as an accounting standard. All goods can be defined or measured in terms of value, in terms of a certain amount of currency, money, and that allows us to compare values, okay? So it's a way of placing a specific price on economic goods and services, a common denominator, a commonly recognized measure of value. We use money as a store of some of our wealth too, right, for the reasons we've talked about. It's the most liquid of assets. We don't like to have too much of our wealth in the form of cash because it doesn't, generally speaking, earn interest, but because it is the most liquid of assets, the lowest transaction costs, we want to have some of our wealth in the form of cash. And then the last piece, forget it. Okay, all right. What backs money? Nothing. Our social agreement, right? That money represents a store of value, can be used to buy goods and services, has worked in the past, will continue to work in the future. In addition, our money is fiat money. We are ordered. That's an order, a fiat. Okay. It's not an Italian car. Okay. By order of the government, you must accept cash, okay, currency. You don't have to accept anything else. You don't have to accept checks, credit cards, stocks or bonds. All right. We already defined money. And that's it for that chapter, right? Was there any homework in that chapter? Oh, wait a minute. Wait a minute. We have fractional. Where's that? Fractional reserve banking. And the Federal Reserve. Oh, that's here. Okay. What's that about? All right, the banks have to hold on to part of their money. Where is that? Is that in this chapter?
No, that's
Or is that in 16? Oh, that's in 16. Okay. Federal Reserve and the money supply. Yeah, that's all in the next chapter, okay? You don't really need to know anything else about the Federal Reserve. I mean, you should read these things and know what the Fed is about, but you're not going to get any questions on the Federal Reserve system, okay?
what about financial intermediation?
No, nothing about financial intermediation either, okay? You have to understand reserves. You need to know the money multiplier, right? We already talked about that. And you don't need to know anything about federal FDIC, deposit insurance, none of that stuff. Okay? That's it. Any question? Oh, there was, let's see, one question. Consider the following data. Calculate M1 and M2. 15-4. Right? So, what's in M1? Cash, currency, 1050. Okay. What else? Traveler's checks. 10. And then we have what else? Transaction deposits. Okay. Correct? 2200? Oh, where'd that come from? Say what? This is 15-4. Okay. What's M1? 1050 currency plus transaction deposits and traveler's checks. And then M2, so that's M1. Now M2, we have small denomination time deposits, 1,000. Savings, 5,500. And then money market mutual funds. There's two. Institution-only money market mutual funds. Does that matter? No. Why did they do that? So that's 800 and 1,800, right? Is that correct? Right? We've got that. Yeah, that's included, right? So we have the 800 plus the 1,800, correct? So these are money market. These are savings, and these are, what are they? Forgot. Time deposits. Oh, that's backwards, right? Oh, no, okay. CDs. Say what? Yes, and then we have to add M1 of 2,200. Okay? You guys all right with that? Okay. No, that would be included also, as far as I can tell. It's a money market mutual fund. So we've got the 800 plus the 1,800, the $5,500 in savings, and the $1,000 in small denomination time deposits, correct? Okay. All right with that? Let's see. 10, 18, 23, 2, 3, 8, 9, 9,300? Are we missing something? Say what? 11,000. Let's see, 3, 4, 9,000. Oh yeah, 9,500. Yeah, okay, that was way off. 11,300? Yeah, bad at adding. Okay. I didn't leave anything out, did I? Here's a question. Yes.
Because here's in the book, the M2 is money market mutual fund balance. It's all money market mutual fund balance except those held by large institutions.
Oh, really? Oh, it doesn't include that?
So here's
Okay. I buy that. I will buy that. I didn't read it. Many. Oh, okay. So you're correct. All money market mutual fund balances except for those held by large institutions, which typically use them as like large time deposits, are included in M2. Very good. So you would take that out. So these would come out, okay? That would come out, which makes this 10,500. 9,500. Right? You're correct. So you wouldn't include those. All right, you guys all right with that? You're not going to get any question like that anyway. All right, let me ask you this. If you move, what? Yeah, 9,500, sorry. Everybody correcting your homework? What if you take $500 out of your checking account and put it into your savings account? Okay? You take $500 out of your checking account and putting it into your savings account. What happens to M1? Goes down by 500, right? So that would be 1,700. What happens to M2? Stays the same. Very good. All right. Okay. There's one more left. Consider a world in which there is no currency and depository institutions issue only transactions deposits. What? What would you be depositing in there if there was no currency? The reserve ratio is 20%. The central bank sells $1 billion in government securities. What ultimately happens to the money supply? Well, we don't. The first statement I don't think is necessary. If the reserve ratio is 20% and the central bank sells $1 billion in government securities, what will happen to the money supply? It will be decreased by what? Right, we have a money multiplier effect here, right? If the reserve requirement is 20%, that's the same as a multiplier of 5, right? So if the central bank sells $1 billion in securities, what are they doing? Are they expanding or contracting? If they're selling, contracting, yeah. If they're selling them, take these pieces of paper, give me your money. So the money supply will go down by $5 billion, okay? $5 billion drop, decrease in the money supply. All right, you guys? Any questions about any of this stuff? No? All right. That's fantastic. All right, you guys. That's all for today.